Every once in a while, the financial world witnesses a move so bold, so unapologetically aggressive, that it forces everyone from Wall Street veterans to weekend investors to stop and rethink everything they thought they knew about markets. This isn't the story of a lucky break or a speculative gamble gone right. This is the story of one man who rewrote the playbook entirely. And the price he may now pay for winning too big. Michael Saylor just executed the most audacious trade of his entire career, and now the old guard on Wall Street seems determined to make him pay for it. We're not talking about pocket change here. We're talking about a staggering $54 billion position. Not millions, not mere billions. $54 billion worth of Bitcoin locked inside a corporate treasury. Saylor's company, MicroStrategy, now holds 649,870 Bitcoin, making it the single largest corporate owner of cryptocurrency anywhere on Earth. Let that sink in. A once obscure software firm, barely recognized by most Americans just a few years ago, now holds more digital wealth than some nations' entire reserves. But here's where the story takes a turn from surprising to downright unbelievable. Saylor didn't simply accumulate Bitcoin and cross his fingers like some overconfident tech founder hoping the charts would go up. Instead, he transformed a sleepy enterprise software company into what analysts have started calling a market cheat code. MicroStrategy evolved into the workaround big money had been praying for, a bridge that gave institutional investors Bitcoin exposure through the stock market without ever touching a crypto wallet. And the payoff? His stock didn't just outperform, it obliterated everything in its path. While the S&P 500 was putting up healthy numbers, and even Nvidia enjoyed its AI-driven moment, MicroStrategy stock went practically vertical. Institutions restricted from holding Bitcoin directly simply bought MSTR shares and surfed the crypto wave through the credibility of a Nasdaq-listed company. Pension funds, hedge funds, legacy money managers, they all piled in. Saylor had found the glitch in the financial matrix. You'd assume Wall Street would applaud that kind of foresight, right? A leader who spotted the future of digital assets early, positioned his company flawlessly, and delivered monumental returns. That's supposed to be the American dream: take a daring risk, execute it with precision, and win big. But here comes the twist that every US investor should hear. The Nasdaq 100 Index Committee doesn't view Michael Saylor as a visionary. To them, he's a threat. According to their rulebook, MicroStrategy has committed what they consider a cardinal offense. By putting more than 50% of its balance sheet into a single asset, Bitcoin, Saylor broke the sacred diversification commandments. The irony is almost unbelievable. The man makes what may be the trade of the century, creates thousands of Bitcoin millionaires, and outperforms nearly every major corporation in America. And his reward is that index authorities are preparing to brand his company as a risk factor and push it out. In their eyes, this isn't innovation. It's a dangerous concentration of risk that undermines their carefully engineered system. And the consequence is coming fast. In traditional finance, punishment doesn't arrive in the form of a polite memo. They erase you. And once you're removed from a major index like the Nasdaq 100, the fallout ripples through the market in ways most everyday investors never see coming. What's about to happen to Michael Saylor isn't just about one company or one crypto-heavy balance sheet. It's about exposing how markets respond when someone wins in a way the establishment never approved. When you corner a massive share of what could be the future of money, you're no longer competing against other traders, you're competing against the traditional financial system itself. And now that system has flipped the kill switch. There's a date circled in red across every major institution's calendar. January 15, 2026. That's when the Nasdaq 100 Rebalancing Committee decides which companies stay and which companies get cut. For ordinary firms, this is routine administrative work. For MicroStrategy, this could be the moment a simple rule transforms into a multi-billion-dollar chain reaction. Here's what most investors never see. When a stock gets tossed out of a major index, it doesn't just lose prestige. It triggers an automatic, unavoidable, system-wide forced selling event, executed with machine-like brutality. Trillions of dollars in passive funds and ETFs are hardwired to mimic the Nasdaq 100. The most famous is the QQQ, holding over $200 billion. These funds don't make human decisions. They follow a single command. Own exactly what the index owns. Nothing else. So what happens the instant MicroStrategy is deleted? Every one of these funds receives the same instruction. Sell MSTR immediately. Not gradually, not strategically, instantly. Institutional trading algorithms will fire off market sell orders with zero concern for price, liquidity, or volatility. Selling a few hundred shares? No problem. Selling hundreds of millions under time pressure? Markets break. JP Morgan analysts have been sounding the alarm, calling it a liquidity trap. And for good reason. The biggest buyers of MSTR today are the very index funds that will be forced to dump it the moment it's removed. Once those mandatory buyers vanish, the market for the stock could evaporate. Picture trying to sell your house on the same day every real estate investor in town is legally banned from buying property. Prices don't slide, they collapse. This is where Saylor's empire becomes dangerously exposed. Remember, MicroStrategy didn't buy all that Bitcoin with spare cash. Saylor used an aggressive financial engineering strategy, issuing convertible notes. These are essentially loans from institutions, giving lenders the option to convert debt into MSTR stock at set prices. It worked brilliantly while the stock soared. But the entire structure rests on a single fragile assumption: there must always be liquidity in MSTR shares. If forced selling collapses the stock below certain thresholds, some convertible note agreements may allow lenders to demand immediate repayment. And the nightmare scenario is obvious. If multiple lenders call their loans simultaneously, where does MicroStrategy get the cash? Their main asset is Bitcoin, massive, volatile, and difficult to sell at scale without wrecking the market. Saylor can't just unload tens of billions on a whim. That kind of move would crash Bitcoin's price, sink the stock further, trigger more loan obligations, and force even more Bitcoin sales. This is the dreaded death spiral, a chain reaction where each required move makes the next disaster inevitable. And there's no regulator ready to intervene, no emergency liquidity facility built for this specific situation. Index rules don't bend. Algorithms don't feel sympathy. January 15th isn't a soft deadline, it's a ticking clock. The committee will meet. They'll look at the concentration of Bitcoin on MicroStrategy's balance sheet. If it still exceeds 50%, the deletion becomes automatic. Saylor knows the storm is coming. Every major institution knows it. Yet there's almost nothing he can do without destroying the very strategy that built his empire. Selling Bitcoin to reduce concentration undermines the entire narrative, and might tank the price anyway. Acquiring other assets big enough to diversify the balance sheet? Nearly impossible in the time left. But what company on earth could he possibly acquire to counterbalance $54 billion worth of Bitcoin? The truth is brutal, no such company exists. The trap is already locked. The gears are already turning. And on January 15th, someone, whether intentionally or not, is going to pull the trigger on what could become the single largest forced crypto liquidation the world has ever seen. Now the only question is whether Michael Saylor has one final escape plan, or if the system is preparing to make an example out of the man who dared to outplay it. So let's walk through what happens if this death spiral actually ignites. Because once the first domino falls, the impact won't stop at MicroStrategy's stock. It won't stop at Saylor's fortune. This could become a wealth-erasing shockwave that hits every American holding Bitcoin. Picture the chain reaction unfolding minute by minute. January 15th arrives. The Nasdaq committee makes its call, and MicroStrategy is officially ejected from the index. Within hours, the passive fund algorithms begin firing their automated instructions. A tidal wave of MSTR shares hits the market with cold, mechanical indifference. A stock that once traded at huge premiums because of its Bitcoin leverage suddenly turns into radioactive inventory every institution wants off its books. As the share price plunges, convertible note holders begin sweating. They watch their investment vaporize in real time and start combing through the fine print of their agreements. Many of those notes contain protective clauses, tripwires that activate if the stock collapses or if the company's finances deteriorate. The phone calls begin. Lenders want repayment. Immediately. And suddenly Michael Saylor is facing an impossible scenario. He could try refinancing the debt, but who would provide fresh capital to a company whose stock is imploding and whose primary asset is the most volatile commodity of the digital age? He could try raising equity, but the forced selling has already turned the stock into quicksand. Every traditional lifeline requires willing lenders or willing buyers. And right now both groups have vanished. That leaves a single terrifying option. The one Bitcoin holders across the globe are desperately hoping never becomes reality. Saylor would have to start selling the Bitcoin. Now you might think, okay fine. Sell some Bitcoin, pay the lenders, stabilize the situation. But that's where the scale becomes mind-bending. MicroStrategy controls 649,870 Bitcoin, over $54 billion at recent prices. But here's the critical truth casual investors don't understand. Bitcoin markets cannot absorb that kind of liquidation. When you or I trade a few hundred or a few $1,000s, the market barely notices. But when someone tries to unload billions, the market doesn't just absorb the hit, it collapses under it. The moment rumors spread through crypto circles that MicroStrategy is being forced to liquidate, every sophisticated trader on Earth starts shorting Bitcoin. Market makers yank their bids to avoid getting run over. Retail buyers freeze. The announcement alone becomes a wrecking ball. And Saylor wouldn't need to sell the full 650,000 coins. According to multiple market analyses, unloading even 10% to 20% of that stash in a short window would overwhelm global liquidity. We're talking about a chain reaction. Automated selling, stop-loss triggers, forced liquidations, margin calls, a cascading flash crash capable of wiping out half the value of Bitcoin in mere hours. Now imagine that shockwave hitting every American who owns cryptocurrency. Maybe you bought Bitcoin in your retirement account. Maybe you listened to advisors telling you it was the future of money. Maybe you just put a few thousand in because you believed in the technology. It doesn't matter. When MicroStrategy sells, your Bitcoin goes down with it. Markets don't care who the early adopters were or who held for ideological reasons. Every wallet gets crushed the same way as institutional portfolios and Saylor's own holdings. But step back for a moment and ask the question no one wants to ask out loud. How did we reach a point where one company's index removal could potentially vaporize billions across an entire asset class? This isn't normal capitalism. This isn't supply and demand. This is a system where a committee's paperwork can unleash forced liquidations throughout global markets like a financial neutron bomb. And here's where the story enters its darkest, most uncomfortable chapter. Because some analysts have begun whispering about a theory that sounds conspiratorial, until you realize the pieces align a little too neatly. They're calling it the bank heist theory. The idea goes like this. Legacy financial institutions have watched Bitcoin's rise with quiet panic. Bitcoin threatens the central machinery of the banking world. They can't print it. They can't multiply it through fractional lending. Payment processors can't tax every transaction. Crypto, if it succeeds, erodes the financial system banks have relied on for centuries. But they couldn't simply ban Bitcoin without proving every critic right. So they needed something more subtle. A way to take control of the crypto market without appearing openly hostile. And Michael Saylor's hyper-aggressive Bitcoin strategy gave them the perfect setup. By letting Saylor accumulate a massive, leveraged Bitcoin position, piled on with convertible debt, the traditional financial system created what military strategists call a kill zone. They let him walk right into it. More Bitcoin. More leverage. More debt tied to the stock price. Everything looked brilliant until the moment liquidity vanished. Now, with a single rule about index eligibility, the establishment can trigger a liquidation event that could drag Bitcoin from recent highs down to $50,000. Maybe even lower. And who will be waiting, cash in hand, to scoop up Bitcoin at those fire sale prices? The same major banks and institutions that publicly question crypto while quietly building the infrastructure to control it. This would represent one of the largest wealth transfers in the history of digital assets. Saylor spent years accumulating this Bitcoin. Early adopters held through every crash. Yet if the deletion triggers forced sales, traditional institutions get to buy the very same Bitcoin at massive discounts. They don't just win, they use Saylor's own strategy against him. The Nasdaq removal isn't merely a punishment for breaking diversification rules. It's the detonator in a perfectly legal, fully automated wealth reallocation mechanism. No conspiracy required. No smoke-filled boardrooms. Just a committee following its rules. And algorithms doing exactly what they were programmed to do. Michael Saylor placed everything, his company, his reputation, and billions in capital, on the belief that Bitcoin would redefine money. And now the legacy Yet if the deletion triggers forced sales, traditional institutions get to buy the very same Bitcoin at massive discounts. They don't just win, they use Saylor's own strategy against him. The Nasdaq removal isn't merely a punishment for breaking diversification rules. It's the detonator in a perfectly legal, fully automated wealth reallocation mechanism. No conspiracy required. No smoke-filled boardrooms. Just a committee following its rules. and algorithms doing exactly what they were programmed to do. Michael Saylor placed everything, his company, his reputation, and billions in capital, on the belief that Bitcoin would redefine money. And now the legacy financial system may turn that very belief into the lever that brings him down. So the real question for every American investor is this: are you prepared for what happens if the largest corporate holder of Bitcoin becomes its largest forced seller? Because the countdown to January 15th is already running. And when the clock hits zero, we'll finally learn whether Saylor's Bitcoin strategy was the trade of the century, or the opening move in the greatest market manipulation of our generation.